Good morning, everybody. Hello, and welcome to another edition of your Bitcoin Economic Calendar, where we cover the news you need to know for the week ahead in Bitcoin. We have lots to cover this week, with Bitcoin closing its seventh consecutive week of gains, up 73% in a 49-day period. We also have very interesting foreign policy moves from the US last week, which could mean very positive things for crypto. We're going to cover that in today's market trends section. And lastly, we're heading into a shortened trading week with US Thanksgiving. We're going to talk about what this can mean for the crypto markets and markets in general. This and more in today's analysis. Now, starting as we usually do with Bitcoin, we usually go right into price analysis, but this week's a bit different because it's getting harder and harder to fit all of the important Bitcoin developments in a minutes long summary. This week, we had two very prominent personalities in finance come out as new Bitcoin bulls. First off, on Wednesday, we had Meltem Demiers be on a guest on the Odd Lots podcast, which I'm a big fan of. The Odd Lots podcast is hosted by Joe Weisenthal and Tracy Alloway, and it's actually one of the most listened to finance podcasts in North America. Tracy, who I am a very big fan of, is the host, has been a host for a very long time, and she has actually written 3 Bitcoin obituaries so far. By the end of the episode, Tracy, like many other investors recently, cited Bitcoin's human capital as the reason she had turned bullish on it. Then we had, days later on Friday, Blackrock's chief investment officer, Mr. Rieter, went on CNBC to say that Bitcoin is here to stay. Now, there used to be a reputational risk associated with being in the Bitcoin industry. This actually seems to be fading very quickly, and not only that, but it seems to be that the crypto industry is now drawing talent from mainstream finance at unprecedented rates. So now let's go on to the price analysis for Bitcoin. Now, moving over to price, we see that Bitcoin had a great week. As we said, it had capped its 7th consecutive week of gains, closing the week up at 18,437, which is up 15.43% for that week. If we include all the previous 6 weeks, it actually has been up 73% in a 49-day period. Now, something to consider here is that we are heading into Thanksgiving weekend in the backdrop of a massive Bitcoin rally and a U.S. central bank that has been vocal about aggressively pursuing inflation. We'll discuss what this can mean in our What's Ahead section later today, but we also wanted to touch on one very important development that happened last week, which was on Friday, the Office of the Comptroller of the U.S. Currency put forward a motion to stop large banks from denying banking services to legal but undesirable businesses. Now, what does this mean? It means that large U.S. banks are no longer allowed to make up excuses to not bank cryptocurrency businesses, among others. To date, this has been one of the largest choke points for mainstream adoption, believe it or not. And if this motion is successful, it can mean another big barrier to global adoption is coming down. Now, moving on to the S&P 500, we see that it closed down 0.77% for the week in a backdrop of increasing COVID cases globally and renewed talks about economic shutdowns. Additionally, the U.S. Secretary of Treasury, Steven Mnuchin, came out with a surprise statement on Thursday requesting the Federal Reserve to return unused emergency funds back to Congress on December 31st. This has been interpreted as an attempt to dampen the new administration's ability to disburse stimulus. Key things to point out here is that the Secretary of Treasury is a position that is appointed by the President of the United States. Furthermore, the funds would be going back to Congress, which is controlled by a Republican majority after the 2020 elections. This sent markets down on Friday, handing them the first down week since October. While there may be some volatility earlier this week, market commentators have highlighted that this week actually marks the start of a very strong seasonal period for U.S. equities. This is the mythical turkey rally effect. Now, can this seasonality also affect Bitcoin? We'll be talking about that in our market trends section. Broadly, analysts have been calling for a continuation of the rally in equities this week, but they do expect some volatility or hiccups earlier in the week like today and tomorrow. Moving over to gold, we see that it had a down week, closing down at $1,870 per ounce, or down 1%. This was likely on the back of Mnuchin's announcement looking to bring back the unused Fed funds to Congress, which may delay any eventual deployment of U.S. economic stimulus. With a shortened trading week and no real activity from the U.S. central bank, and in the context of a lame duck presidential administration, it is likely that we're going to see some sideways action on gold until we have a catalyst in the market to push it in either direction. Moving over to the Ftx D5 Index, we see that it had another rockstar week, up 13.99%. However, as we mentioned on the last BEC, the rise in value of these tokens is likely due to the rise in value of Ether and Bitcoin, both of which are widely used as collateral on these DeFi platforms. In fact, if we look at the price action on Ethereum, which we're popping up on the screen just now, we see that it was up 25% last week, meaning that DeFi tokens are in fact lagging behind Ethereum. In euphoric markets, speculative tokens tend to be high beta with Bitcoin and Ethereum. This means that they make similar directional moves, but they tend to be much more aggressive. We're not seeing that right now. So all in all, these are the signs of a healthy market or a healthy rally for both Bitcoin and Ethereum at these levels. In today's market trends section, we're going to talk about a very important recent foreign policy move by the United States and the potential implications that this can have for the crypto industry at large. Last week, we saw that the United States partnered with Circle and RTM for a new global policy objective in Venezuela. Venezuelans are in a tight spot. The country is ruled by a dictatorial regime that has systematically dismantled its institutions, eliminating any chance of a democratic election. The international community has condemned the regime and has tried to help the Venezuelan people. To date, it has identified regime officials as criminals, sanctioning them personally, as well as the regime-run oil company. These strategic sanctions have been implemented in a way that they limit any negative impact that these measures can have on the broader Venezuelan people at large. The tools that were used by the international community to date have been defensive or restrictive from a policy standpoint. They were meant to prevent bad actors from benefiting from the global financial system. Offensive policy moves, such as sending aid directly, had been previously stopped by the regime. Financial aid was stopped by blocking access to the local banking system, and the physical aid was blocked by literally blocking the bridges with empty containers to prevent food and medicine from crossing. I think we all remember this episode back in February. But now the US government is going on offense and it's enlisting a new unstoppable weapon for its policy goals: US dollar-backed stablecoins and crypto companies. The US government has seized sovereign funds belonging to the Venezuelan people from the criminal regime and has been looking for ways to return it back to the Venezuelan people. It started trying to do so by working with the last democratically elected body left in Venezuela, the opposition-led National Assembly, which is led by the interim president Juan Guaido, which is a name you might have heard. Earlier this year, the US government had announced that it had plans to test a new delivery system to get this financial aid to the Venezuelan people, sending the dollars to pre-screened individuals using a crypto company's P2P disbursement system. The test worked. It delivered two $100 payments to 62,700 healthcare workers, and they're looking to disperse a total of $18 million. Now, the United States government is doubling down and expanding the reach of this initiative. Enter USDC. Details here are very important. The previous iteration of the program did not explicitly mention the use of stablecoins. In it, RTM's P2P payment system were seen as the rails through which the recipients could exchange the crypto into local currency. This would help them bypass the regime's block to send the financial aid directly into the local banks. To understand why this is working, P2P crypto exchanges are very, very difficult for the regime to control, since in the financial system, it only shows as a standard bank transfer between two parties. The regime is unable to stop these transactions without actually bringing the financial system to a halt. However, it can put pressure on local banks to screen and monitor anybody that may be interacting with this platform, which can put pressure on the local banking system. And it creates complications and risks potentially for the people receiving it. Now, USDC is the most compliant and liquid US dollar pegged stablecoin in the market. By giving it its blessing, the United States government has signaled that it is okay with compliant Venezuelans holding and transacting in USDC, not forcing them to exchange to local currency or making them feel that they are at risk for using it. This opens the door for Venezuelans to foster and encourage the use of USDC internally, to create a circular USDC economy outside the purview of the illegal regime. This is a huge sign of encouragement for companies like ourselves. We deeply believe dollar stablecoins can provide credit and savings opportunities not previously available to people in Venezuela, and at world-class standards. Ourselves and others, we have been pushing to educate Venezuelans and the region at large about the benefits of US dollar-pegged stablecoins to escape local inflation. This policy change can have a huge impact and huge positive implications for the future of crypto. And it's a huge step forward for stablecoin adoption in distressed economies. The United States seems to be waking up to the potential of US dollar-pegged stablecoins as a tool for foreign policy. If used correctly, this can help drive an agenda of economic progress worldwide, even in places where the incumbent regimes are deliberately trying to hold its citizens back, like Venezuela. Moving over to our Bitcoin mining difficulty commentary, we saw that last adjustment brought difficulty up to 17.56 terahashes, and hash rate has come roaring back into the network since. We are now gaining back a few days into our next difficulty adjustment, which is no longer projected for next Monday, but this coming actual Sunday. Why does this happen? Why do we gain time into adjustments? Well, the same way adjustment periods can become longer when hash rate drops, they can actually be cut shorter when too much hash rate enters the network too quickly. So we're currently looking at an upwards adjustment of 18.99 terahashes for this coming Sunday, which will take us close to October's all-time high in mining difficulty of 20 terahashes. Now, as always, we leave you with what's ahead for the week. Thanksgiving week is always an interesting one for Bitcoin and financial markets in general. It is a time when families in the world's largest economy gather to discuss the year and current events. Now, let's take a minute to appreciate the current backdrop going into this year's holiday. First, we've had a monster Bitcoin rally with very little evidence of retail investor euphoria, as per the data that we were looking at in last week's episode. Second, we have a US central bank that has been very vocal about pursuing inflation. Third, we have a Democratic administration that will likely pursue an aggressive stimulus package in light of renewed shutdown pressures and soaring infection numbers. Fourth, we just had PayPal give access to 346 million accounts to purchase Bitcoin, many of them in the United States. Fifth, we need to consider that the industry's infrastructure has matured to accommodate new entrants and new capital at exponentially higher rates than in the 2017 rally. While all of these items set the stage for a potential turkey rally, it is important to keep an eye on metrics that let us gauge market euphoria so that we can plan accordingly. We love Bitcoin very much, but nothing goes up forever. And while the secular trend is undeniably upwards and to the right, it is important to be well positioned for potential short-term volatility. As always, we'll keep you posted with any relevant information throughout the week in our social media accounts at Hodl with Ledin. And if you don't yet have a Ledin account, go visit ledin.io and learn how you can start earning 6.5% APY on your Bitcoin and 11.7% APY on your USDC. Lastly, if you like what you saw and you learned something today, make sure that you click on the subscribe link below and share the episode today. Thank you so much and have a great week. See you next time.